Economic growth in Australia has slowed considerably since the Reserve Bank began hiking rates in May of 2022. We've had 5 quarters in a row of negative growth in real per capita GDP. That is, if it hadn't been for the extraordinary surge in population growth, largely as a result of higher immigration, then Australia would have found itself in what the media would have called a technical recession. And we'll probably have had another quarter of negative growth in real per capita GDP in the second quarter of the year, for which the figures will be released next Wednesday. From a different perspective, the unemployment rate has risen by 0.6 of a percentage point, from 3.6 to 4.2% as of July. So clearly the Reserve Bank's moves have had an impact, particularly on the third of Australian households who have a mortgage. And in Australia, most mortgages are at floating rates. So what the Reserve Bank does with its official interest rate flows very quickly into the interest rates that are actually paid by households. And that's why consumer spending has been so weak. On the other hand, business investment has been quite resilient. And as the Reserve Bank has pointed out to the government's displeasure, government spending by both the federal government and by Australia's state and territory governments has also contributed significantly to overall demand. So although inflation has slowed at 3.5% or 3.8% in terms of the Reserve Bank's preferred measure of underlying inflation, there's still quite some way to go before the Reserve Bank will be in a position to follow other central banks in starting to cut interest rates.
Right, and you mentioned that Australia's GDP growth has been in decline since the Reserve Bank rate increases. Do you think it's likely that the central bank will start cutting rates?
I don't think they will this year. I mean, it's important to note, I think, that although interest rates have gone up quite a lot in Australia since May of 2022, at 4.35%, the Reserve Bank's cash rate is well below those set by its peers in the United States, in the United Kingdom, in Canada and in New Zealand, where the cash rate got to 5% or more at its peak. And although 3 of those banks have now started to cut rates, and the US Federal Reserve almost certainly will at its next meeting, even with those cuts, their interest rates will still be significantly above the Reserve Bank of Australia's 4.35%. The Reserve Bank of Australia has consciously chosen to tolerate inflation being above its target for longer than its peers in the other countries that I've mentioned have been willing to tolerate inflation being above their respective targets, in order to preserve as much as they can of the gains that were made in 2021 and 2022 in reducing unemployment to levels that were previously thought unattainable or unsustainable. Now, that's meant that inflation hasn't fallen as quickly in Australia as in those other comparable countries. The benefit, if you like, of that is that unemployment hasn't risen as much as it has in those countries, but it stands to reason that because inflation is falling more slowly, and also because Australians have received, beginning on the 1st of July, income tax cuts that in aggregate are equivalent to 25 basis point reductions in official interest rates in terms of their impact on household cash flows, that the Reserve Bank of Australia is going to be lagging behind its peers in starting to cut rates. I don't expect that they will cut rates until February next year.